Here's a paradox for you. How can it be that after years of central banks spewing out new money with quantitative easing, that global markets are facing a liquidity crisis? Let me reveal all. Since the financial crisis began in 2008, central banks have added an eye-popping $10 trillion of cash to the world's money supply. And yet, as recent volatility in the government bond market shows, there can be real issues with liquidity when it comes to doing deals in the real world. You still need two parties to make a trade, so one of the reasons for markets seizing up is good old psychology. If I'm nervous about what's going to happen, I may decide to do nothing. You also need two different views of the future. If everyone agrees the market's going up, why would anyone sell? If we're all convinced there's going to be an almighty crash, where will the buyers come from? A recent poll by Bloomberg showed the bizarre statistic that 100% of economists they interviewed believed that American interest rates are about to rise. As a contrarian, that makes me keen to bet they're all wrong. But how many takers will there be for a deal that everyone else agrees is a one-way bet? If you've seen any of my recent articles about the new FCA regulations in the UK, you'll know all about the unintended consequences of tighter regulation. Well, it's also impacting the bond markets. The tighter rules on banks have reduced their ability to act as market makers during times of turbulence. They've had to reduce their stock of bonds by up to 80%, leaving a wafer-thin margin if everybody wants to buy or sell at the same time. The market would simply seize up, leading to even wilder swings in buy and sell prices as people become desperate to offload assets at any price just to get some cash. Our old friends, the fund managers, are also part of the problem. They're increasingly measured against a narrow range of benchmarks, which leads them to follow the herd in their buying and selling decisions. There's quite a bit of consolidation going on in the fund management industry at the moment, with the world's top 20 asset managers responsible for 30% of all bond and equity holdings. That's double what it was a decade ago. So 20 managers could move the market substantially with a buy or sell decision. And then, of course, there's programmed selling by computer systems. Most of them work on broadly similar algorithms, so they tend to react to a given set of circumstances in a similar way. With all these factors tending towards a lot of selling decisions within a short time, all it needs is a few nervous days to start triggering a rout. And yet investors seem blissfully ignorant of this, assuming they'll be able to get out before the solids really hit the fan. For all the reasons that I've stated, that could be a naive hope. There are lots of reasons why things could go wrong across the world at the moment. I don't need to remind you of the Middle East, Ukraine, Turkey, Egypt, Canada. If you're holding lots of stocks and bonds and playing a game of dare about when to exit the market, be very careful out there. If you ask me, when a legend like Buffett can get it so wrong with his narrow and deep focus, I feel even more comfortable with the Elite Investor Club strategy to own the world.